Module 1. The Basics of Technical Analysis. The philosophy of technical analysis. There has long been discussion over whether the markets are random or cyclical, with evidence from both sides to prove the other wrong. The random walk hypothesis states that markets follow an efficient path where no form of analysis can provide a statistical edge and will not follow any patterns or trends, and that past price movements cannot be used to predict future price movements. The efficient market hypothesis states that at any given time, security prices fully reflect all available information and evolve according to a random walk. The implications are that most individuals that buy and sell securities, stocks in particular, do so under the assumption that the securities they are buying are worth more than the price that they are paying, while securities that they are selling are worth less than the selling price. But if markets are efficient and current prices fully reflect all information, then buying and selling securities in an attempt to outperform the market will effectively be a game of chance rather than skill. There's a huge amount of evidence produced to support this theory. Ironically, efficient markets depend on market participants who believe the market is inefficient and trade securities in an attempt to outperform the market. The other side of the fence is the non-random walk theory. Fundamental and technical analysts such as myself believe that there is a certain rhythm to the markets that careful analysis can help to uncover, providing at least a slight advantage. Day traders in particular believe in the non-efficient market hypothesis and believe they can beat the market, which is why they trade short-term moves in search of profit. So, we believe that the market can be predictable to a small degree, enough to help us reduce risk and increase reward in our favour. Fundamental analysis focuses on news events and the overall state of economies, taking into account economic indicators and forecasts which are released on a daily basis. Traders may also consider the health of individual companies and sectors to help them decide what news and events will dominate the market at any particular time and form a basis for their strategy to make a profit. Technical analysts such as myself, we believe we can spot trends and patterns from historical data that provide lower risk entry and exit levels on a trade. My personal belief is that the market is determined by the interaction of supply and demand, both rational and irrational. Technical analysts know that financial markets tend to move in trends that persist for an appreciable length of time, and therefore, if the trend can be spotted at an early stage using the appropriate tools, an edge can be gained and a trade can be held until the trend is deemed to have ended. Many of these trends will repeat over time in a rather consistent manner. So we believe that changes in a trend are caused by the shifts in supply and demand, and that it does not matter why they occur, only that they do occur, and that they can be detected sooner or later using charting techniques. I strongly believe this. Technical analysis, therefore, is a useful tool in the forecasting of future price of financial markets based on historical price movements. Like weather forecasting, technical analysis is not perfect and will not produce 100% certainty about where the market is going or in what time period. But it can help traders anticipate what is likely to happen in the future using a variety of charts that show price over time. Technical analysis was established when the system of pricing goods on the open market first began in Japan as early as the 18th century. However, most of its methods, as we know them today, were created in the first decades of the 20th century and have been used by an increasing number of professional traders, including those at major banks and funds who regularly publish the findings of their analysis for the benefit of their clients. Technical analysts, sometimes also called chartists, we believe we can gain a clearer idea of the current psychology of the market through historical price action displayed on charts. Patterns on these charts can indicate the flow of demand and supply and which side will likely prevail, and we believe that these patterns will repeat themselves in future price action. The field of technical analysis is based on three assumptions. The market discounts everything. Price moves in trends. And history tends to repeat itself. Technical analysis does not require constant monitoring of fundamental information, as it only considers price movement. This is one of the major advantages that I find. It's assumed that at any given time period, the price of an instrument already reflects everything that has happened or could affect the outlook, including fundamental factors. It assumes that all the market players are following the news and they've absorbed that information. So, for example, we believe that a company's fundamentals, along with the broader economic factors and market psychology, are all priced into the stock by participants, removing the need to actually consider these factors separately. This is a big advantage and time-saving assumption because we only need to monitor price movement and volume traded, which technical theory views as a product of the supply and demand of a stock or financial instrument. Fundamental analysis would try to estimate a company's intrinsic value to determine whether its stock was a good or a poor investment. A technical analyst, such as myself, is not concerned with the value in the same way, but the likely future price movement of its shares instead, and we don't care for the fundamental reasons of why this happens. Moreover, technical analysis can be applied to practically every financial market, equities, bonds, commodity futures, currencies, etc., without having to trawl through pages of economic or company reports. Only a charting package providing historical data for the required instrument or stock is necessary, and these are very affordable these days, accessible to anyone with a PC. It was a lot more difficult when I first started this, and you had to actually manually chart prices. One of the first things a technical analyst will try to spot is the trend of the market, because after a trend has been established, the future price movement is more likely to be in the same direction as the trend than to be against it. Most technical trading strategies and many algorithmic black box systems are based on this assumption. It is often assumed that prices either trend upwards or downwards, but prices also can spend a lot of time in a sideways trend or moving within a range. This is important, especially at the moment as I record this. Lots of markets are trending sideways. Many traders simply look for markets that are trading within a range and wait to enter and exit the market at either ends of the range. This has been a very successful trading strategy. Remember, the trend is your friend. However, there are more often than not several trends which can be more clearly seen over different time periods. Different time periods is key to technical analysis. For example, in a monthly chart we can find a long-term trend which actually consists of many smaller trends. We can then observe the weekly, daily and intraday chart, which may be 4, 2, 1 hour or less. Some people even look at 5-minute, 1-minute charts. It's possible that different time periods will have contrasting trends. In fact, it's likely. Trading in the direction of the trend means you start by determining the direction of the long-term trend. You have to look at the longer-term charts first and then gradually move to lower time frames. But the key trend to watch should be the one corresponding to the time horizon during which you want to have the position open. We'll explain more on that later. The repetitive nature of price movements is attributed to patterns in human psychology that do not change, as market participants tend to provide a consistent reaction to similar market stimuli over time. Technical analysis uses chart patterns to analyze market movements and understand trends. Although many of these charts have been used for more than 100 years, they are still believed to be relevant because they illustrate patterns in price movements that often repeat themselves. There are many different types of approaches to technical analysis, to technical trading, and the most commonly used methods can be divided into two sections. 1. Pure chart analysis, where we try to find recognized patterns that occur repeatedly. For example, head and shoulders or double bottoms. These are patterns you may have heard of. They're considered typical chart patterns and ones that can work well to give a trader an edge, offering a low-risk trading opportunity based on the direction of the price. Based on the direction the price should follow, depending on the type of pattern. Then there's the second one is technical indicators and oscillators, such as relative strength index, RSI, you may have heard of that, moving averages, stochastic oscillator. They can sometimes give an indication of the underlying strength or weakness in the market. Most traders use a combination of the two, and that certainly includes me. Types of charts. Understanding how to read the line, bar, and candlestick charts. There are three basic types of charts used by technical analysts to read historical price action. The first was used quite a lot when I first started in the industry back in the 1980s. It's called a line chart. In those days, the internet did not exist, and many analysts actually plotted charts by hand on graph paper. It was, in fact, my father who got me interested in the business, and he would sellotape pieces of graph paper together and manually plot the closing price of the FTSE 100 index with a pencil and join up the dots each day. He'd actually have this graph paper stuck to the wall. We'd have walls full of this chart paper. So this was useful for spotting the prevailing trend, but the line chart is no longer used by technical analysts now that we can download data in less than a blink of an eye. The next step up from a line chart is the bar chart. Each bar represents a period of price action with the open, the high, the low, and the close. For example, on a daily chart, the small line appearing on the left of the bar indicates the opening or the first traded price. The low of the bar is, of course, the low for the day, and the high of the bar is the high for the day. The small horizontal line appearing on the right of the bar indicates the closing or the last traded price of the day. But bar charts aren't really used that much these days anymore either. So here's an example of a bar chart. Anyone can now obtain accurate historical data for free on the internet or through a broker. Many trading platforms include free charting packages which could be good enough for a short-term day trader. The Japanese candlestick is now the most widely used chart amongst traders and analysts. The candlestick takes the bar chart one stage further by creating a body within the bar between the opening and the closing price. The body of this candle is given a colour, usually blue or green, if the closing price is above the opening price, or red if the closing price is below the opening price. The wick of the candle appears above and below the body, indicating the high and low of the day in exactly the same way as the bar chart. Often the colour of the wick matches the colour of the body. By just glancing at the candle, you can see the day's range, and if the price had a significant move from the opening to the closing. The colours really help for obvious reasons. It's also very easy to quickly see where the price opened in relation to the day's range and where it closed in relation to the day's range. All this information, when put together on a chart and compared to the candles of previous days, can give strong clues to future price action. At first glance, this can help not only give an indication of the trend, but also the momentum within that trend. For example, if we're in a positive or bullish trend and the candles within that trend have big blue or green bodies, this indicates strong positive movement within that trend. If the candles have only very small bodies with long wicks, this tends to indicate more indecision on the part of market participants and may be a sign that the bulls are losing control, meaning the positive trend may be running out of steam in the short term at least. Bulls want to see big-bodied blue candles, showing that the market accelerates from the open and closes near the high of the day. The key to successful day trading is mastering the principle of trading support and resistance. The most successful traders in the world, I'm sure, would have to admit they could not predict where the markets will go day after day with any degree of accuracy. It's incredibly hard to predict short-term price movement hour to hour or with a 24 to 48 hour period, even within a week or month. To do that consistently is very, very difficult indeed. So what do successful short-term traders do to make profits on a daily basis? Okay, this is what we do. We look for the important levels in the market where we can enter low-risk trades. These support and resistance levels are where the market is likely to pause and perhaps reverse. A support level is a price level where the market tends to find support as it's experiencing a correction in the bull trend. So the market goes up, it hits profit taking, it comes down and it meets a support level. This means the price could very well bounce off this level rather than break through it, and is more likely to do so the first time it's tested. However, once the price has passed below this level, perhaps on the second or third test, it is likely to continue dropping until it finds another support level. So in a bull trend, you are looking to buy at support levels, expecting the bull trend to eventually resume. A resistance level is the opposite of a support level, of course. It's where the price tends to find resistance as it's going up, especially in a bear trend. Experienced traders tend to wait to sell at resistance and buy at support as this gives them the best trading edge. If the price is moving within those levels, they tend to just wait and leave it alone. There is no edge. If price is moving between support and resistance levels, therefore traders buy at support and sell out for a profit as the price approaches resistance. They also sell short at resistance and cover the short buyback for a profit taking as the price approaches support. That particular strategy works well in a range trading market. So if the market's clearly moving within a range trading sideways, you can buy at support and sell at resistance throughout the day. How do I correctly identify key support and resistance levels on a chart? The most basic way to spot a support or resistance level is to look back for areas where prices tended to stabilize for a period of time. So in the next chart, the short pink lines indicate areas of support or resistance where price has stalled. These areas will often work again in the future when they are revisited. It's worth making a note of these levels on your chart and perhaps creating a list to use as a reference point. The purple lines show how these support and resistance levels can work well into the future. An important point to note is that once a support level has been broken, it tends to act as resistance. Day trading is a psychological game, and if you have watched the price bounce at a particular level several times, this price level will tend to stick in your mind. This has an effect on many of the market participants, and they will judge this as an area to enter or exit trades in the future. When a resistance level is broken, it also tends to act as support. Think of it like this. At any one time, there are traders with long positions and opposing traders with short positions. So if, for example, the Euro-US dollar traders holding longs notice that the price has been supported around 110.30 for 2 hours, many may feel comfortable as long as that level holds and decide to put a stop loss in just below at, say, 110.10. If the level is broken and many traders have stopped out the long position, they will have that 110.30 level imprinted in their minds over the next days. They won't be able to forget about that. They have an emotional connection to it. If the Euro-US dollar were to fall a little bit further and then bounce back up to the 110.30 level, those traders that were still holding longs would see this as an opportunity to exit their positions for almost no loss. Those that were stopped out of their longs will see this area as resistance to try shorts and see if the Euro-US dollar moves back down again. The traders with short positions may be happy that the market is trending in their direction. They will also remember that 110.30 acted as support on the way down. They may decide to add to their short positions at this level. All these market participants will reinforce this area as resistance on the bounce. It's psychologically imprinted in their brain because they sat there watching the screen and remember how the price reacted when it hit that level on the way down. This is why areas of support and resistance, such as in the chart below, continue to work over and over again.